When looking at stocks and property, which would be the better asset class to invest in? Which would be the one to help you create more wealth in the long term, create more income, generate a better return? In this video, I'm going to share with you 7 factors to consider as to whether you should invest in stocks, property, or if you're looking to do both, how should you think about allocating your portfolio? My name is Daniel, and I make videos every week to help you make money in property investing. So this video has been the long-awaited showdown between stocks and property. Many of you have been asking me, hey Dan, I have enjoyed your series on property versus different asset class. What kind of consideration should we be thinking of? And if you have been following the playlist, you can check it out here in the description below. You would know that there are pros and cons to every asset class. However, property is a great asset to have in your portfolio. And a lot of times the consideration is it an active income or a passive income? And whilst you could be making a good return on active income sources, you will always want to create passive income sources as well, so that that can continue to generate you wealth regardless of what you're doing. You could be anywhere in the world, you could be sleeping, and your assets are still working hard for you. So let's jump straight into the first factor, and that is liquidity. Well, obviously that in terms of stocks and property, stocks gives you much greater liquidity. You can buy and sell and it's instantaneous. Whereas with property, it takes longer. It's not going to be immediate. It's not going to be a matter of days. In fact, I get this question a lot. Hey, Dan, if I want to sell my property, how quickly will I be able to cash out my property? Or some people ask it in a, in a way that says, will my money get stuck in the property? Well, it really depends on what your time frames are. As always, I always tell investors that if you want to invest in property, it should be monies that you don't need to touch for at least the next 3 to 5 years. And in that case, you will not be in a pressure to sell the property, right? And you can put the property on the market, you can take more viewings, and you would get a reasonable offers coming in that are reflective of the market value of the property. So this all comes down to your research process, where you can find the right properties in the right locations, where if you want to sell it, there's going to be a good demand for those properties and it will fetch you a good value as well. So I would say always, and this is a tip for you, always factor in 4 to 6 months to market your property to be able to sell it at its prevailing market value. That is fairly liquid to me, because these are monies that I don't need to touch for the next 3, 5, 10 years anyway. And I always recommend having a safety net of savings to say 4 to 6 months of your expenses. And this would cover, your rainy day fund, whatever you call it, right? Such that you will not feel the need to sell your properties just to pay off something else. Okay, so that's the first one. The second thing is about how much capital is required. And obviously with stocks, you could start with a very small amount, even a few $100s, whereas with property, it tends to be higher in capital. However, a lot of people think that I need millions of dollars to get started in investing in property, because they think of investing in property in Singapore, buying a condo, for example. However, if you know, and by the way, if you haven't already subscribed to our channel, make sure you do that and click the notification bell so you're informed whenever we have a new video every week. But we invest primarily in the UK, and you can buy terrace houses for as little as £100,000 or even less, which is less than 200,000 Singapore dollars, which if you think about it is crazy, because that's half the price of a HDB, and you can get a landed terrace house property, oftentimes freehold, and by the way, still cash flowing. All right, so the capital required may not be as much as you think for a property in the UK. However, compared to stocks, definitely you can get started with stocks with much lower capital. So for those of you who are starting out with a smaller amount of capital, 10 grand, 20 grand, stocks might be a good place to start, but please get yourselves educated. Regardless of whatever asset class, the biggest investment you can make is to get your education. The biggest asset you can own is yourself to create wealth, right? It's not about trying to gamble and get rich quick through the stock market. And that's how I personally lost the money when I first started. When I was still studying, I was still a student, I first graduated, I tried to get rich quick. There were days I made monies, 5,000 a day. I was so over the moon, and the next day I lost it, right? So in stocks, they're really trading and investing. You need to know which is a better fit for you. But regardless, stocks is not an asset class to try to get rich quick as well. There are people who are very successful, but I know they do it with lots of discipline and in a system. So regardless of the asset class, you need to have a system and you need to have discipline to then follow the system. And this is the same for stocks and property. So let's go on to the third factor, which is volatility. So for property and stocks, I think the answer is pretty clear. Stocks definitely are a lot more volatile. In a short period of a few weeks or even days, the stock can go up 10, 20, 30, 40%, and it could also come down vice versa. In fact, if you buy the wrong stock, the stock price could just crash and whatever you've invested is gone. Whereas with property, if you're buying a property that people live in, there is a desirable place where people want to stay in it, it's very unlikely that the property value will drop to zero. And that is the beautiful thing. And that brings me to the next factor, that property is a tangible asset class where you can touch it, you can feel it, even if with inflation and even if the dollar, and people talking about the dollar is devaluing because people are printing more. And think back to the days of barter trade where you had to use a huge wad of cash to exchange for maybe a few tomatoes or for a sack of rice. And that's the beautiful thing, right? When you have a tangible asset, not just computerized or script in stocks, like asset, like property. If people are using a lot of cash to buy a sack of potatoes, for example, you can be sure that by relative value, the property providing a shelter, a roof over your head is going to be worth much more, right? So this property in itself is an anti-inflationary asset. They will always hold its value. Okay, so let's go on to the next factor, which is how much control you can have over the asset. With stocks, well, the control is in the selection, and which is the same, selecting a good stock with good fundamentals, maybe a good timing to enter. However, once you've bought the stock, there's very little you could do to make the price go up or down, right? Which is why you try to buy it with good management, good track record, whatever. However, with a property, even though you do your due diligence up front, you buy a property that is in a good area to rent out, it has good rental demand, has good connectivity to amenities, for example. But even after you've bought the property, you still have control over the asset. There are things you could do to the asset that could add value to it. For example, you've heard of this thing called curb appeal, right? If the garden in the front and the door doesn't look great, that alone could cost you 3 to 5,000 in your valuation of the property, because first impressions count, isn't it? So if you change a new kitchen, a new bathroom, things like that, all of that add value to the property, and which is what we as professional investors do. And you might want to write this down. We force the capital appreciation on the asset. This is such an important lesson. If you just take this one lesson away from this video, it's going to be amazing, because a lot of amateur investors buy and hope that the property goes up, appreciates over time. Whereas for us as professional investors, we buy the asset and we know, for example, how much it costs to add a kitchen, a new bathroom. And with that investment to refurbish the property, we know how much more it's going to add in value to the property. And that's how we force the appreciation. All right. So going on to the next factor, it is, and the last factor, it is about both and, not either or. What I mean by that is, a lot of people say, should I buy stocks or property? Well, the answer is eventually both. Why? Because stocks gives you that liquidity. It allows you to start with little capital required to start with. And over time, you could build a good portfolio. But once you have that, and I know quite a number of friends and investors have done that last year when COVID presented a great opportunity. Those that have bought stocks a lot, and good stocks, a lot of them have made phenomenal returns, and they're now looking to put their money into property. Same for investors who have done really well in the crypto space. You see the price of Bitcoin just skyrocketing, or as crypto investors would say, going to the moon, and they believe it's going to go up further in the months to come. But a lot of them, once they've made their profits, and this is an important thing, to take profits on your stocks, or these assets that are liquid, because you could be a millionaire one day and you could be left with very little overnight if it crashes. But with the profits that they take, a lot of them are then looking and they're asking me, hey Dan, if I want to buy in a safe and secure asset that generates me passive income, how can I do that in property? Right? And that's a great space to be in, by the way. So this is the beauty of it. It's both and, a way to make active income, but at the same time, you want to be building your passive income over time. building it to a point where it covers your basic expenses, your utilities, your basic food expenses for a start. And that's a huge milestone. And of course, you can build it further from there. All right, I missed out one factor, which is leverage, right? With stocks, there's very little you could do. No bank's going to tell you that you just put $25 down and I lend you $75 to buy 100% of a stock. But in property, you can do that. Why are banks willing to do that? Because they know that property is a safe asset. It has inherent value, and regardless what happens, they can always sell the property and they'll get most of their money that they have lent to you back, right? So I hope you enjoyed this video. This is the last of this series of property versus different asset classes. Let me know what you think in the comments. Do you agree? How do you apportion your stocks and property portfolio? What other questions you have? And this is Daniel signing out. See you at the next video.